Welcome to the debate. Welcome to Breaking News to Trading Moves. When you board a commercial flight today, the pilot barely touches the controls for the vast majority of the journey.
Right, mostly just takeoff and landing.
Exactly. The mathematics of aviation are so precise, the algorithms so optimized, that human intervention is often the highest risk factor in the cockpit.
Well, that works perfectly in clear skies. But the moment you hit severe turbulence or, say, an unexpected mechanical failure,
You need the pilot.
you absolutely need the pilot. You don't want an algorithm just consulting historical averages while the plane goes down. You want a human being who can feel the yoke, assess the immediate reality of the situation, and make tactical, calculated decisions to keep the plane in the air.
And that tension is exactly the core debate we are examining today. We are looking at the tension between purely automated passive investing, things like your index funds, robo-advisers, and immediate lump sum capital deployment,
Right.
versus the necessity for behavioral safeguards and tactical active market engagement. So we are talking about dollar cost averaging, human advisory, and swing trading.
Yeah.
We're evaluating whether a mathematically optimized, sort of lazy approach is objectively superior for wealth building, or if the psychological realities of human behavior and the structural vulnerabilities of automated markets demand a more active approach.
To do this, we will connect the dots across multiple financial frameworks, spanning from Nobel laureate mathematics to modern behavioral finance and technical trading realities.
Right. I will defend the undeniable mathematics and efficiency of strict passive automation.
And I will champion the behavioral necessities and targeted opportunities found in active, measured market engagement.
So let us start with the unyielding reality of arithmetic. The laws of mathematics dictate the success of passive investing over active management.
Okay, lay out the math for us.
We can look directly to William F. Sharpe's zero-sum game theory to understand exactly why.
Right, so to put that simply for anyone listening, you are saying that before you pay any fees, the market is just a giant pie, and active traders are merely trading slices back and forth.
Exactly. It is a closed system. Before costs, the return on the average actively managed dollar has to equal the return on the average passively managed dollar.
Because the market is the market.
Right. The market return is literally just the weighted average of all the securities within it. But after costs, because active management requires paying for research, trading fees, and bid-ask spreads, active management must perpetually underperform.
Because they are paying for that friction.
Precisely. And the S&P indices versus active scorecard, commonly known as SPIVA, proves this mathematical certainty in the real world. In 2021, 79% of active fund managers underperformed the S&P 500.
Which is a staggering failure rate for people who do this professionally.
It really is. And when we extend that timeline out to 10 or 20 years, the failure rate of active management only grows worse. Therefore, lazy portfolios, like the Bogleheads 3-fund portfolio comprising total U.S., total international, and total bond market indices.
The classic set it and forget it model.
Exactly. Combined with algorithmic robo-advisers, they offer maximum efficiency. They provide low friction and reliable market returns that simply outpace human interference.
I come at it from a different way, actually, because human beings do not invest in a mathematical vacuum.
What do you mean by that?
Well, you are describing a frictionless theoretical universe. But in reality, strict passive strategies, like immediate lump sum deployment, fail to account for cognitive biases like loss aversion.
How so? I mean, the math doesn't care about our feelings.
The math doesn't, no, but the person holding the account absolutely does. When an algorithm automatically drops a lifetime of savings into the market right before a macroeconomic crisis, the resulting panic can trigger catastrophic selling.
Which locks in the losses.
Exactly. That destroys whatever mathematical edge the investor supposedly had. Furthermore, placing global capital on autopilot introduces structural perils.
You're talking about the macro impact now.
Yes, Robert Shiller accurately described passive index funds as a chaotic system and a pseudoscience. They blindly allocate capital based on market capitalization rather than underlying business fundamentals. Strategic active engagement provides vital risk management that pure automation completely misses.
Let's actually look at the mechanics of putting that initial cash to work, though, because honestly, the numbers Charles Schwab pulled in their 20-year study are staggering.
Oh, I know the study you are referring to. This is the one tracking hypothetical investors putting $2,000 into the market every year.
Yes, exactly. And it tells a fascinating story. First, we have Ashley Action, who represents immediate lump sum investing. Every January 1st, she just drops her money in.
Rain or shine.
Right, regardless of what the market is doing. Over 20 years, she accumulated $170,555. Now contrast her with Peter Perfect.
Peter Perfect being the mythical investor who perfectly times the market bottom every single year.
Right, he has a crystal ball. He never misses the absolute lowest price point of the year. And yet, he ended with $186,077.
So he won mathematically.
He did. But the mathematical gap between never timing the market and flawlessly timing the market for 2 decades is barely $15,000. Perfection is barely better than immediate action.
That is a stark comparison, I will admit.
It gets better. Now contrast Ashley with Matthew Monthly, who used dollar-cost averaging. He spread his investments out over the 12 months. Matthew ended up with $4,000 less than Ashley.
But look at the behavioral protection Matthew received for that relatively small cost.
I have to stop you there, because I am not finished with the data, and the contrast gets much starker when we look at the cautionary tales.
Okay, fair enough.
Consider Larry Linger, the investor who stayed in cash perpetually waiting for a market crash to find the perfect moment. Larry ended the 20 years with a disastrous $47,357.
Because the crash he was waiting for either never came or when it did, he was too scared to buy anyway.
Precisely. But here is the most crucial data point. Even Rosie Rotten, an investor who had the worst luck imaginable and bought at the absolute market peak every single year right before a drop.
Ouch.
Yeah, terrible timing. But she still accumulated over $150,000. She vastly outperformed staying in cash.
Wow. So even being terribly wrong is better than doing nothing.
Exactly. Being Rosie beats being Larry every single time. The arithmetic is clear. Getting capital into the market immediately, without trying to time it or spread it out, is the superior mechanism.
That is a compelling argument. But have you considered the behavioral principle of loss aversion defined by Kahneman and Tversky?
Let's connect the dots there. How does that apply?
Well, I will readily acknowledge the data from Vanguard and RBC Global Asset Management. They show that lump sum investing wins mathematically 68 to 75% of the time.
Which is a heavy majority.
It is. But Kahneman and Tversky proved that the psychological pain of losing $100 feels roughly twice as intense as the pleasure of gaining $100.
I am familiar with the concept. But how does that negate the mathematical advantage of lump sum investing?
Because it dictates human action. If you are listening to this right now and you have $50,000 sitting in a savings account, you are probably terrified to put it all into the market tomorrow.
Sure, it is intimidating.
It is terrifying. If a lump sum investor puts their entire net worth into the market on a Tuesday and the market drops 20% on a Wednesday, the pain is so intense that they often liquidate their portfolio at the bottom.
But that is an educational problem, not a mathematical one.
It doesn't matter what kind of problem it is if the money is gone. The moment they panic and sell, their mathematical advantage is utterly destroyed. Dollar-cost averaging is not a performance strategy designed to beat lump sum investing.
Then what is it?
It is a crucial coping mechanism. It spreads the experience of risk over time, allowing the human nervous system to tolerate the volatility.
I'm not convinced by that line of reasoning. Relying on dollar-cost averaging to manage emotion is like keeping your emergency brakes slightly engaged while driving on the highway just in case you need to stop quickly.
That is a clever analogy.
It provides a false sense of security while guaranteeing worse gas mileage.
Financial markets are not highways, though. They are obstacle courses.
But the drag on performance is real. Tangible money lost. You are systematically keeping a portion of your capital in cash, earning minimal returns, while waiting for purchase dates that will mathematically likely occur at higher prices.
But you are assuming they stay the course.
I have to ask, is it intellectually honest for financial professionals to prescribe mathematically inferior strategies just to coddle emotions rather than educating investors on the reality of market mechanics?
It is absolutely intellectually honest, because the most optimal portfolio in the world is useless if the investor abandons it during a drawdown.
You think the behavior always overrides the math?
Without question. The hierarchy of investment decisions is simple. Being in the market beats being out of it. And maintaining your strategy during chaos beats fleeing to cash.
Okay, I see your point.
If dollar-cost averaging acts as the emotional insurance that keeps capital engaged, the slightly lower expected return is an entirely acceptable premium to pay.
Okay, so let us say you get the money into the market, regardless of the method. Moving from that initial deployment of capital to the ongoing management of a portfolio, we must examine whether algorithms should take the wheel for the rest of the journey.
Right, the maintenance phase.
The evidence strongly suggests they should.
You are talking about robo-advisers here, I assume?
Yes, platforms like Betterment, Wealthfront, and Scalable Capital. They automatically rebalance portfolios without emotion. They reinvest dividends through DRIPs.
For the sake of clarity, DRIPs being dividend reinvestment plans.
Exactly. So instead of a dividend sitting in your account as dead cash, the algorithm immediately buys fractional shares of that same company.
Putting the money right back to work.
It keeps your money constantly compounding without you lifting a finger. Furthermore, they execute tax loss harvesting instantly.
Which means selling a losing position to offset capital gains taxes and then immediately buying a similar asset so you do not lose market exposure.
Spot on. And they do all of this relentless monitoring and execution for minimal fees, ranging from 1/4 to 0.5%.
Which is very cheap, admittedly.
Human advisors cannot monitor accounts with that level of relentless precision. We can look at the long-term success of vehicles like the Lexington Corporate Leaders Trust, ticker LexiXC.
Oh, the one from the 30s.
Yes. It has run virtually on autopilot since 1935. It proves that a static, automated approach removes the friction and cognitive errors that drag down performance over decades.
Automation works brilliantly for single portfolio in isolation. I won't argue that. But when you scale that automation globally, you introduce systemic peril.
Systemic peril? That sounds a bit apocalyptic.
It is a real concern. Passive managers like Vanguard, State Street, and BlackRock now control massive portions of proxy voting power.
You are arguing that index funds are getting too big?
I am arguing they are altering the mechanics of free market capitalism. We have to look at Benjamin Braun's concept of asset manager capitalism.
Walk me through that.
Let me give you an analogy. Imagine watching a professional sports game, but the same referee is secretly managing both teams on the field.
Okay.
There is zero incentive for those teams to genuinely compete. When extreme diversification becomes the default, it leads to shareholder apathy.
Because the index fund owns everyone.
Exactly. If the same 3 index fund providers own the top 5 companies in every single industry, they have no incentive to encourage fierce competition between those companies.
I see.
This can lead to monopolistic pricing and a stagnation of corporate governance. The algorithm does not care how a company operates. It only cares about the market capitalization weight.
But those structural macroeconomic theories, while debated in academic circles, do not negate the personal wealth-building power of the algorithm for the individual investor.
For the individual, algorithms still lack the necessary human element when it matters most. Consider the market crash of 2020.
The pandemic crash.
Exactly. When portfolios were dropping 30% in a matter of days, an algorithm could only provide generic frequently asked questions on a website.
They did send reassuring emails, to be fair.
An email doesn't stop a panic attack. Human advisors were the ones answering the phones, talking high net worth clients off the ledge, and keeping them from making disastrous emotional errors. You cannot program an algorithm to provide empathy or to understand the nuance of a complex family business structure.
Yet that human empathy costs the investor 1 to 2% of their assets under management every single year.
Which covers the cost of the relationship.
But over a 30-year horizon, that fee erosion consumes an enormous portion of the compounding returns. The math dictates that paying a human to hold your hand is a luxury most portfolios simply cannot afford.
So if we agree that pure automation carries structural macroeconomic risks, but paying a human advisor 2% a year eats all your profits, where does that leave the average person?
Are they just stuck?
Exactly. Are they stuck? This is where I think deliberate, active trading actually makes sense for the modern investor who wants to avoid high advisory fees, but also wants to avoid the blind adherence of index funds.
Active trading. You are suggesting an individual tries to beat the market themselves?
Active engagement does not require the frantic pace of day trading. We can look at the methodologies of position trading and swing trading.
Okay, explain the difference.
Well, trader Kendrick G., known as Lingo, outlines a philosophy where one does not need to trade every single day.
How does that work in practice?
An individual can use technical analysis to identify great setups at established support and resistance levels. A support level is simply a price where buyers historically always step in to stop a stock from falling.
Okay, so buying at the floor.
Right. By executing calculated swing trades around these levels, an investor can let successful positions run for 100 to 500% gains. This targeted, risk-managed approach to specific market trends directly answers Robert Shiller's critique.
The pseudoscience critique we mentioned earlier.
Right. Instead of index funds blindly buying every stock regardless of valuation, a swing trader analyzes the underlying price action and deploys capital surgically.
I see why you think that, but let me give you a different perspective based right back on William Sharpe's arithmetic. If swing traders are hunting for these great setups, they are generating immense friction.
They are generating opportunity.
No, they are generating costs. They incur much higher trading costs, short-term capital gains taxes, and bid-ask spreads on every single entry and exit.
But the gains can outweigh the costs.
I must ask for evidence that this targeted approach can consistently overcome the 11.5% annual average return of lump sum passive strategies identified in the RBC asset management data.
The evidence is in the individual discipline.
But the reality is quite grim for active retail traders as a whole. Data clearly shows that 70% of retail CFD accounts lose money. The math shows that attempting to surgically extract alpha from the market usually results in the market extracting capital from the trader.
That 70% failure rate in retail accounts is a symptom of chaos, not a failure of the methodology itself.
Chaos from the traders themselves?
Yes, it often stems from over-leveraging and poor emotional control, which is exactly why disciplined position trading is different. A meticulous swing trader who waits for high probability setups and utilizes strict stop losses is operating a defined risk management system.
But they are still fighting the algorithmic tide.
They are not trying to be a chaotic day trader. They are taking deliberate, calculated positions to capitalize on medium-term swings. This requires effort and education, certainly, but it allows the individual to bypass the systemic risks of asset manager capitalism while maintaining control over their own capital allocation.
Maintaining control is an illusion if the strategy mathematically degrades your wealth compared to a simple automated index fund.
It doesn't have to degrade it.
But statistically, it does. The laws of arithmetic ultimately dictate outcomes. Low-cost, passive index funds, combined with immediate market entry and automated reinvestment platforms, offer the most reliable, evidence-based path to wealth building.
That is your summary, then.
It is. Every layer of human intervention, whether waiting to deploy cash, paying a human advisor, or attempting to swing trade, introduces friction, fees, and emotional liability.
I maintain that markets are driven by human psychology and structural mechanics, not just idealized math. Ceding total control to algorithms exposes individuals to emotional panic during crises and ignores the structural risks of blind capital allocation.
So you firmly stand by the active approach?
I do. Tactical, measured, active strategies, whether utilizing dollar-cost averaging to survive a volatile period or employing position trading to capture defined trends, serve as a vital bridge between theoretical math and the reality of human behavior.
We have thoroughly examined the mechanisms driving both sides of this equation today. We have looked at the unyielding arithmetic of zero-sum game theory, the compounding power of automated platforms, and the undeniable behavioral realities of loss aversion.
And while we approach the methodology from different angles, there is a profound point of convergence here.
Which is?
We both firmly agree that participating in the market, Whether you are trusting a passive algorithmic pie to reinvest your dividends or carefully managing a technical swing trade, is vastly superior to the wealth-destroying effect of staying in cash.
Absolutely. As the Schwab data showed, even Rosie Rotten, buying at the absolute peak every year, defeats Larry Linger waiting on the sidelines.
The numbers prove that inertia is the true enemy of compounding wealth.
It is up to you, the listener, to draw the lines within your own risk tolerance and psychological framework. We encourage you to explore the material further, to understand the mechanics of these platforms, and to determine how much of your financial journey should be trusted to the autopilot.
Because eventually, every investor has to decide whether they are comfortable sleeping through the turbulence or if they need to keep their hands firmly on the controls.